Bonds and fixed income have a big part of your portfolio. And if you're already retired, it's probably an even bigger part of your portfolio. They generate income for you, they reduce volatility. There's a whole lot of other things that it does for you too. And I'm not sure if you've been following the bond markets lately, but things are a little crazy. So stick around and we'll talk about what's going on and how it matters to you. Warren Buffett just released his annual letter a couple of weeks ago. And for those of you that don't know what that is, Warren Buffett is one of the most successful investors in the history of the stock market. And he manages a fund called Berkshire. Every year, he releases a letter outlining his thoughts of the overall market to his shareholders. And this year's letter had some really interesting things going on. So we're going to put it up on the screen and I'm going to read it for you here. And bonds are not the place to be these days. Can you believe that the income recently available from the 10-year U.S. Treasury bond, the yield was 0.93% at year end, had fallen 94% from the 15.8% yield available in September of 1981. In certain large and important countries, such as Germany and Japan, investors earn a negative return on trillions of dollars of sovereign debt. Fixed income investors worldwide, whether pension funds, insurance companies, or retirees, face a bleak future. A lowering interest rate environment can cause some challenges because as interest rates go lower, that means that the yield on the bonds that you're invested in are also going to be lower as well, meaning you're earning less on those investments. But this can turn out to be a double-edged sword. So take this for example, in 2011, 12, 11, something like that. The 30-year bond, which is the bond that's way out there on the duration, right, was yielding somewhere around 5% in a falling interest rate environment. Yet from then until now, we've seen that same bond have volatility as much as the S&P 500. We're talking some examples I looked up were years that had losses of 23%, 15%, 18%, just to name a few. Guys, if you go check, stockcharts.com, ycharts.com, this is where this information is coming from. So think about that. You have S&P 500 volatility in a bond investment that's supposed to be the brakes on your portfolio. And to think that the F fund currently holds around 40% in treasuries could mean that you're not really as safe as you think you are. Now, let's be clear. I'm not here to predict whether or not there's a rising interest rate environment, right? The Fed's been clear about their indications. I'm merely here to break the status quo of the old rules that you had in portfolio management, where if you're retired, now you have to have a 60-40 portfolio for your retirement. I'm really just here like a beacon. Take Alan Grant waving the flare in front of the T-Rex in the Jurassic Park movie, if you've seen that. So the economy is changing, and that's the point. It's changing, and as a sophisticated investor, you need to be changing with it as well. But guys, make sure you don't confuse risk and volatility. Those are two different concepts, but investors make this mistake constantly, and we see it time and time again where people think that the market is moving and their portfolio needs to be rebalanced. Well, maybe, but maybe not. Maybe you're looking at volatility. Risks come in different forms, and interest rate risks are really what affect the bonds that we're talking about today. So speaking of interest rates, I want to talk a little bit about why we saw interest rates move up a hair very recently. And if the thought of that makes your eyes glaze over, then just skip to the end of this video. We're going to talk about a couple more things before we wrap up. So for everyone else, all the economic nerds out there, follow me along this journey. So for the last decade, we've been seeing interest rates go down and down and down. Yet, out of nowhere, we saw interest rates spike right back up, and it was such a hard hit in such a short time, even though it was a relatively small amount. It even had the markets having some sort of knee-jerk reaction to it. The reality is that rates have been adjusting really because we have a better prospect of the future. So the world is coming around this pandemic and people are being vaccinated. And so the expectation is that things are going to get a little better. And that's baked into the yield and the yield adjusted returns already. So take that into consideration. But most people were simply just meditating at what the Fed was going to do and whether they were going to bring in additional policy to hike rates or if it was just cool as a cucumber for the next few months. You know, you might remember this. It used to be that there was a media camera person zooming in on the briefcase from the Fed chairman as they crossed the street, hoping to catch a glimpse of, loose leaf paper sticking out the side as if that were some sort of indication for new policy that was coming in. And these days we have Twitter and people speculating over Reddit and all kinds of different mediums. As we continue to see interest rates slowly creep up, that could also have an impact in the equity markets. So US large caps, so very, very large companies. So this is similar to your C fund and your S funds, right? These specific funds and groups of companies are vulnerable to rising interest rates. So if you own these two funds in your TSP, either through just selecting the core funds or maybe you have it through your life cycle fund, you just need to make sure that it's set up properly, right? And that your allocation and your mix and your blend is appropriate for your retirement goals. And I say your retirement goals, not your neighbors, not your coworkers, not your bosses, right? It's a specific number that belongs to you relative to your life in your circumstances. The next thing I'll say, which I know doesn't really matter to any of you guys because you're all smarter than this and you're more sophisticated investors, but please don't try and time the market. I know that we've been talking about some economic impactors to your portfolio, and timing the market is one thing. Aligning your portfolio and making changes to your investment so that it fits your retirement goals, it fits your other goals. Maybe you're moving and you want to get another boat or whatever those things are. That you can do. Timing where the top of the market is and where the bottom of the market is cannot be done. You can't do that unless you have a crystal ball. So please don't try to do that. There's an old saying that says, bulls make money, bears make money, and pigs get slaughtered. And that comes from Wall Street because they're talking about when the market is going up, bears, when the market is going down, right? You can still meet your goals, make money, right? And do everything that you want to accomplish for yourself because you're aligning your investments in the way that they should be to meet your goals. We may very well start to see interest rates rise again, which is it's pretty common and follows an improving market, right? And if we do see an environment like that, we're going to look at higher yields, right? And higher yields usually lead, historically, to a generous repricing of the stock market. And that's where volatility comes in. And that's where I'm talking about you need to just be prepared for that. Make sure you're set up right. A little volatility is okay. A lot of volatility could be okay. Depends on a lot of different factors. When are you touching the money? What is the purpose of the money? Right? Are you in dying investments, right? If you're holding funds and just giant pools of money, are there specific companies in those pools that maybe aren't doing so well and maybe you shouldn't be hanging on to them anymore? What type of control are you having with that? All different things to think about. So what you can do about it, which helps me as an investor, I don't know if it helps you, but it helps me. And so I'm going to give you this tip. If you stress test your portfolio, meaning you know how it's going to do if the market flips upside down, or if there's all kinds of variables hitting your life. Maybe you have a really bad health incident. Now you have some really high medical costs, right? If you're stress testing your portfolio, you know where to make those adjustments. Stress test to be stress less. Okay, that was a terrible joke. We're going to cut that one out. Cut that one out, okay? And guys, the point here is just to make sure that you're staying seated during turbulent times. And when you've done the proper planning, you've done the analysis on it, you know what your implications are, you know what your potential risks are, and those things are just going to help you sleep better at night. They're going to help you stay invested. They're going to help you stay seated when there's turbulence. So for those of you that decided to skip through the technical analysis of what's going on in the interest rates environment and in the markets as a whole, we're back to the point here. I challenge you to think differently. Your portfolio works in all kinds of market conditions, good ones, bad ones, medium ones, right? Medium ones? Is that a thing? It is now. Just make sure you understand how these pieces come together. Rising interest rate environments have an impact to the markets, which have an impact to your portfolio, which have an impact to what you're doing in retirement, when you're retiring, what you want to do, where you're going, all of those different things. So think differently. It's not a 60-40 portfolio that's going to get you through retirement all the way. Having winning investments is great, but aligning them with the things that are most important to you in life is the true value of money and the wealth that you've created for yourself, right? And keeping up with what's going on in the economy, yeah, that's important, but not if it's keeping you up at night, not if it's causing you anxiety and causing you stress, and not if it's forcing your hand and making a decision about your portfolio or rebalancing or doing something. See, now we're getting to the behavioral economics element of this. So know this stuff, it's important, but make sure that it's all well controlled. And if good enough is fine with you, then great. But aren't you curious to find out what are the different things that your money can do for you? You've accumulated this wealth for you and your family. What kind of freedoms can it buy you? How can it shape the rest of your life? And guys, that's all we have for today. Make sure you're subscribing to the channel, sending this off to your friends, hitting the like button, commenting below. All of those things really help us to be able to know what it is that you guys are looking for. So if you hit the bell icon, you get a little notification anytime that we push out a new video. So I know you're going to enjoy that. So we'll catch you next time, guys.